To discuss the alpha thesis philosophy, which underpins the work of the growth equity strategies team at Loomis Sayles, I'm joined now by Hollie Briggs. She is head of global product management at the team. Well, Hollie, first of all, can you tell us a little bit about the alpha thesis philosophy?
Yes, certainly. The alpha thesis really defines what we believe are the key drivers of our long-term success, which we define as generating alpha. In summary, we are active managers with a long-term private equity approach to investing. We're looking to invest in a few high-quality businesses with sustainable competitive advantages and profitable growth, but we only want to invest in them when they're selling at a discount to intrinsic value. The overarching premise of everything we do is our long investment time horizon. This allows us to take advantage of what we understand about recurring asset mispricing. Most investors have innate biases that lead them to be short-term in nature. These include herd mentality or recency bias, which can cause investors to act in unison, typically overreacting to near-term headwinds, which when viewed rationally from a long-term perspective, have no impact on its intrinsic value. Generating alpha is about pursuing upside potential while managing absolute levels of downside risk. So every aspect of our philosophy are designed individually and collectively to meet this dual objective for our clients.
And how long have you had this philosophy up and running for? Has it changed at all over time?
It hasn't. We first started managing the large cap growth strategy in 2006. So we've been using the same philosophy and process and alpha thesis for over 17 years.
But the skeptic might say that was a period where we were about to go into QE. The world feels very different now. You've had a great run, but it's a very particular set of monetary conditions. And also there was globalization, and that feels that it's going into reverse. Why are you so confident it's going to not just survive, but thrive in potentially very different market conditions?
You know, there's a narrative out there now that's been out there since interest rates started going up that says growth is dead because money is no longer free. Well, one of the criteria we have for a high quality company is that the business is structured through a model that generates free cash flow growth. Generating free cash flow growth is liberating for a business because it can fund its own future growth. They're not dependent on going to the debt markets or issuing more shares. So our companies have been successful even in quantitative easing, not because of quantitative easing, right? So we've been funding our own future growth. So now as interest rates go up, because the companies in all of our strategies have low or no debt, they're not having increased borrowing costs, their margins aren't pressured.
When you were describing the alpha thesis philosophy, right at the core of it is this concept of intrinsic value. So what do you look for as a team that allows you to work out what the intrinsic value of a business is?
Well, you know, we're a growth manager, growth equity strategies, and yet we use the term intrinsic value about as much as a value manager does. And for us, this is important because we want to make sure we are creating a margin of safety by buying at a discount to that estimate of intrinsic value. So we prepare long-term, forward-looking models, right? Usually our models are about 10 years forward-looking. For a pharmaceutical company, it could be even 15 years forward-looking. We spend 2.5 to 3 months on every company that we research. So we're doing a really deep dive, looking at the full industry value chain, using Michael Porter's 5 forces to look at all the competitors and substitutes to really have a deep understanding of what we do. And from there, we can build out our models. For 10 years, we are looking to understand what the cash flow generation is going to be year by year because we use the present value of future cash flows to generate our estimate of intrinsic value. We also engage in another step around valuation, which is called expectations analysis. It's really a scientific approach that looks at the reverse. If today's price were true, what else would have to be true? So basically, you would start with the price and build out the assumptions that would make that price true. Then you can compare exactly where your view and the valuation reflected in today's price, where those assumptions vary to help you understand how and why the stock has upward potential.
A little earlier, you mentioned that you really like buying stocks that are masters of their own destiny. They produce their own cash flow. It's got nothing to do with QE and cheap money. But again, a skeptic might say, well, I've spotted things like Netflix in the top 10 holdings of some of your strategies, and that was definitely a cash burn company for a while. So how does that fit into the thesis?
So, when it comes to measuring profits, for example, and looking at cash flow, here's the things we think about. First of all, they had the cash to spend because they were generating it, right? You have to get to a level of scale in order to create free cash flow growth so that you can invest in your own future growth. Tesla is a company that in the early days, it wasn't clear they were going to be able to achieve scale. There were other traditional automobile manufacturers that were going to move into the EV space, but they deferred and deferred and deferred, and Tesla was able to create scale, generate scale, and therefore earn free cash flow growth. Another company that had free cash flow growth but didn't have EPS for many, many years, but nonetheless was one of the most profitable companies in our portfolio, was Amazon. Amazon didn't have any EPS for years, but what they were generating, and this is why we care about free cash flow growth, and we also care about the long-term vision of management. We want that cash flow put in the hands of managers who think in terms of decades, right? So that they're allocating capital to projects that generate returns that are greater than the cost of capital. If you're creating returns that are greater than your cost of capital, you are creating more capital. You can earn EPS and not be earning above your cost of capital. That would be a cash burn that we're worried about, right? You can't do that for very long. But you can have zero EPS and be generating more free cash flow growth and profits above that so that you can continue to invest in your own future growth.
And how would this make your approach different from that of other growth managers?
I think about it in terms of the word structural, and this goes with long term. Everything we look at is structural. It's not short term. It's not top down. It's not the current macro environment. Many teams will try to determine what the macro environment is, what the magnitude is going to be, how long it's going to last, and then consider how can they take advantage of that environment or protect their portfolio from that environment. We are simply looking for high quality companies. That's our starting point all the time. And these drivers like free cash flow growth, managers who think in terms of decades, sustainable competitive advantages, these create high barriers to entry. And those characteristics, that criteria works together to create a virtuous cycle. If you're generating free cash flow growth, putting it in the hands of managers who think in terms of decades, who are good allocators of capital, they generate more free cash flow to put in the hands of management. So being quality, becoming quality, is very hard to displace that player. We're looking for the long-term structural winner. And the growth we're looking for is also structural, right? We're shifting to e-commerce. You think that's an old story, but globally, ex-China, e-commerce has only penetrated retail spending about 14%. We've owned Amazon for over 17 years. When we first bought Amazon, the penetration was 2%. 17 years later, it's only 14%. And we think it can go to 35%. So every driver of growth are these shifts that are not going to be derailed by a business cycle, by inflation rates, by a change in government in some country, right? Because they're structural.